The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody, welcome to today's webinar. Appreciate everybody hopping on. This is Jacob Locke over here on the marketing team at ORG, and we're really excited for today's webinar. We have a good partner of ours, and John Hancock hopping on the call today. We'll go over some niche sales concepts that we think you guys will find interesting, specifically, finding these opportunities for car dealership owners. Think this is going to be a great opportunity. We have Kimberly Lips here. We have the advanced markets team here at John Hancock. We'll save questions for the end, but feel free to ask them throughout the presentation, and we'll get them addressed when necessary. So, Kimberly, I'll swing it over to you to get started, and let's rock and roll.
Hi, well, thanks everybody for joining. I'm Kimberly Lips. I'm a regional VP with John Hancock, and today we have with us from our advanced markets team, Tracy Olam, one of our attorneys. She is an expert in this opportunity with car dealership owners. I've used her in a lot of conversations with advisors who have clients in this market, and so I think you're going to find it interesting. And if you have some car dealership owners, there's definitely an opportunity for some planning that hopefully you'll be ready to go have those conversations after this call. So Tracy, I'll turn it over to you.
Thank you very much, Dustin and Kimberly. So thank you for joining today. So one of the things that we're focusing on at John Hancock is taking some of the cases that we've had over the past couple of years and kind of boiling them down and saying, why did it work so well for that that market, and can we recreate that, or can we help other folks find that same opportunity in a similar marketplace, or for clients that might have a similar profile. So the one that I'm going to focus on today, or spend a little bit more time on, is one that came up at the end of last year that was around car dealerships owners specifically. So this was a case that that I had worked on individually with a producer and a client, but then realized after talking to other folks about the success that it really did translate well, and we found multiple new opportunities similarly in the car dealership market. So how essentially what happened here, we had a producer called in. He had a client, a high net worth client, was engaging in estate planning, and had needed about $5 million in more death benefit, more liquidity for that estate plan that he was looking at. So in this case, the client had already used a majority of their lifetime exemptions, so we didn't really have any gifting options available. We had to find another alternative to get the money or the cash to fund that liquidity need, or that life insurance death benefit. So in this case, the client's primary wealth was held in car dealerships owned in part with his two brothers. So the problem we had was that he wanted and needed to buy the life insurance, but the wealth that he had is highly illiquid due to those franchise agreements. So we needed to find that liquidity. We needed to find that extra cash to pay the premiums, while at the same time, not using any more taxable gifts, because again, we had kind of used up, or he was limited in what we could use from gift exemptions and any more lifetime exclusions. So in kind of distilling the case, some of the questions that popped up, or what we started to look at in this client profile is, can we dig into what the makeup of the assets are, and can we find a way, or get creative to find a way to do what we need to do? So questions that we asked were, what was the ownership structure of the dealerships? We worked pretty closely with the CPA in this case to kind of distill down what the assets were, what those assets had already been earmarked for, and if we could kind of come up with something a little bit different. We asked the question, did prior estate planning involve trusts? What other income producing assets are there? What was there already being held in the trust? How were those assets being utilized as well? And then ultimately, what other assets did the client have, or either business have, that they had ownership in, and was there anything else there that we could be flexible or use for this type of planning? So what we determined was, in working with the CPA, we actually found an LLC that was not a party to the franchise agreement. So what we found in kind of, the problem as it sat was with those franchise agreements with the car manufacturers. The car manufacturers have essentially a first right of refusal to anybody that comes in to be a signer or an ownership in that franchise agreement, which meant that we couldn't use the car dealerships themselves as part of the planning process. The franchise agreements limited the ability to use those assets and transfer to trust or for gifting or anything along those lines. So in distilling down the asset balance sheet, what we found was we had another business entity essentially that had the same name as the car dealership itself. It's just that behind that it said LLC. So asking additional questions, we found that we had this LLC that owned the actual real estate where the dealerships were located. So they owned the ground and the building, and they had named that LLC the same as the dealership name, but it wasn't a signer on the franchise agreement. So it was completely a separate business entity. So we kind of zeroed in on that as a potential opportunity to have that income producing asset. We also realized that they hadn't really thought much about that land and what the transition was going to be there from an estate planning perspective as well. So what we were able to do is, take a look at that and find out what's the income coming into that LLC, how is the client currently using that, is there any flexibility there? And the solution that we came up with was essentially a sale of the real estate LLC to a grantor trust, or a sale of an asset to a grantor trust. So I'll take a step back for a second and say, what does that solution look like? What did we do here? So a sale to a grantor trust and how that works, essentially, in this case, we're going to take an asset and sell it to the grantor's ILET, or the client's ILET in this case. The grantor is going to take a note back, or an installment note back at with interest at the current AFR rate. In this case was 4.3%. So we do typically have a seed gift that has to be contributed to the trust to make this sale look to have economic substance to it in the eyes of the IRS. In this case, we're using a trust that already exists, so the grantor didn't need to make any seed gift to that trust. It was already fully funded. In doing so, we're using then the income from that asset from the LLC to pay the premiums on a life insurance policy, which will ultimately have the death benefit payable back to the trust and effectuate that death benefit then going to his kids or his heirs at the end of the grantor's life. Benefits here is that because we're using a grantor trust in between the grantor, they're considered the same person for income tax purposes, but separate entities for estate tax purposes. So there's no recognition of gain on the sale and no income on those interest payments when the trust makes those AFR payments back, or those interest payments back. So it is a non-taxable essentially sale from the grantor to the trust, and then the interest comes back to the grantor and is not taxable either. So benefits here, we were able to fix an interest cost, again, in this case, at the midterm AFR rate. It gave us the opportunity to freeze the value of that asset. So by selling the asset, the appreciation or any future appreciation of that real estate was outside of the estate, even though the installment note was actually still inside the estate for estate tax purposes. And then we're using that income generated from the asset in order to purchase the life insurance, and essentially leveraging that up. Again, it's an income tax neutral transaction. So some of the things that we were, kind of wrestling with or had to come up with is, in this case, they had actually just done the CPA had a recent appraisal on that property, so we didn't have to go out and get an appraisal, but that can sometimes hold up these types of transactions if we need to get an appraiser to value the property that we're selling, as well as potential loss of control of that portion of the asset that's sold to the ILET. A couple other reasons why this makes sense in cases where we're looking for true, trying to get additional dollars out of the estate, we are able to use leverage. Again, we have to have economic substance. So keeping in mind that we have that seed gift there, we're usually able to do at least a 9-to-1, looking at a 9-to-1 debt to equity ratio. And it didn't really matter in this case, but just kind of giving you a, in future cases, it really does give us the ability to maybe make a small gift, but then leverage into a much larger transition or larger transaction, depending on what the size of the estate truly is. We do have other strategies as far as dealing with the loan. In the future, he could forgive the loan, complete the gift. He could essentially repay himself with either asset growth later on down the road or taking the asset back, or other income that's held in the trust can come out to repay that installment note as well as the opportunity to use discounting and discounts for lack of control, lack of marketability to get additional value essentially out of the estate as well. So in this case, why it worked for this client, back to the numbers that we were using, the client in this case actually was able to sell about $3 million share of his real estate LLC to the ILET. That funded trust, again, because we already have funding in the trust, we've already done the gifting. No seeding was actually necessary for this transaction, it was already there. But that funded trust used the annual income from that real estate to purchase the $5 million death benefit with a premium of about $160,000 a year. So what that looked like for the client then is first and foremost, the client took that, we used a discount, in this case, a minority interest discount, because we only sold a small portion of the real estate itself. The client actually took a 30% discount on that $3 million real estate share and received a note back of about $2 million. This ultimately got us to a point where we got $1 million out of the estate right up front, and then $2 million in a note was still maintained as part of the estate for that client. In the interim, the client is going to receive annual interest payments at the AFR rate, about $93,800 each year. Again, that comes back to him from the trust tax-free. The annual rental income that they had actually renegotiated with the dealership itself was about $350,000 coming into the trust specifically. So we use that $350,000 to not only pay the premium, but also pay that interest each year. So we kind of backed into what they needed to get there. That $350,000 is income to the trust. However, it is tax deductible still as rental payments or rent paid from the dealership itself each year. Additionally, we were able to show appreciation of that asset being outside of the estate. So at $2 million inside the estate, we got a $3 million asset out. And if we look at life expectancy for this client at 3% growth of that asset, it's about $5.4 million that's now outside the estate of that asset value itself. In addition, we were able to purchase $5 million of coverage, ultimately about 10.4 total to the kids or to the heirs. Because we're using trust planning, they also succeeded in making that business succession reality with this real estate as well. So the trust beneficiaries will inherit the LLC interests. But again, in this case, they also had estate equalization problems with 1 or 2 of the kids being part of the dealership, another 1 or 2 not being part of the dealership. They didn't want those 2 that were non-active to somehow get control and try to sell or negotiate or kind of hold hostage this real estate from the other 2. So putting a trustee or a trusted advisor in that trust to kind of help manage that property will hopefully lead to success down the road as well for those kids that are staying in the business, as well as for, an income source for the kids that are not in the business as well. So that's essentially kind of how it worked for the car dealership profile or car dealership owner profile. We've seen some success in that marketplace. I've also seen similar cases come through working with other franchise type owners, folks that have franchise agreements. I know that Northern Indiana, I think we had cases that were, RV dealership or RV dealership owners, similar franchise type agreements with those manufacturers that those folks are dealing with as well. So in addition to the car dealerships, we're also focusing on this concept of client profiles as well. So we do have one-pagers, such as a one-pager here showing that car dealership owner case study, the client profile, questions to ask, and a potential solution, kind of walking through those pieces as well. We do also have these similar profiles for wealthy global citizens in the foreign national marketplace. We have dedicated resources and underwriting specifically for this marketplace. So I think we'll be back to talk about some of these in more depth as well, future webinars. We also have concentrated stock portfolio and family farmer client profiles ready to go, with a few more on the way, such as commercial real estate, among others. And for any of these client pieces, we do also have a great piece called our Client Navigator, which just kind of walks through, potential situations where, what a client may be facing, their concerns and potential questions to ask to kind of help develop a case and develop what that potential solution may look like for those individual clients. So with that, I'm gonna open it up for questions. If there's anything anyone wants to talk about, we can certainly walk through any of that. I know I went really quick in a case study with a concept that can get pretty complicated quickly as well. So happy to answer any questions that anyone has related to that.
Yeah, we'll open it to questions. Looks like we have a few here, and then Kimberly, I'll let you go over what you wanted to talk about as well. Looks like the first question here, it says, is the interest cost fixed?
So the interest cost in this case is fixed at the time that we enter into the note, yes. So whatever the AFR rate. Now keep in mind, we do have the ability, if at any time they want to extend that note or change the note terms, they can renegotiate with the trustee in this case, which may and could change that interest rate down the road as well.
Cool. Another question here says there was the freeze of future asset appreciation. Is that correct?
So it's a freeze of future asset appreciation in the estate, because again, we're transferring the asset out of the estate and taking back the installment note. So the note value stays in the estate itself, but we're getting the asset itself out, and any growth on the asset is now held in that trust and is not includable in the estate.
Sure, thank you. Looks like a couple more. Is there a minimum dollar amount with this concept?
So no minimum dollar amount. There is going to be some costs in setting something like this up. Costs for drafting trusts, costs for attorney's fees. There's typically costs in valuation if you have an evaluation that's required on the asset itself. So there's no minimum dollar amount, but it's usually somewhere at least, and it doesn't have to be ultra high net worth like we talk about with a lot of estate planning cases, but definitely someplace in the middle net worth kind of area.
Sure. Yeah, absolutely. I appreciate that. It looks like that's it for questions on that so far. Kimberly, we want to turn over to Kimberly, and you can share what you want to talk about, Kimberly.
Sure. First, I did just want to add, so Tracy and anybody else, any of the other attorneys on our advanced markets team are available to have conversations with you. And in addition, assuming that client already has some sort of an estate planning attorney that they work with, she certainly is able to speak with those professionals on the client's team. Our attorneys just cannot speak directly with the client themselves, but certainly can serve as a sounding board if the attorney or CPA want to have any conversations with one of the attorneys, our team who are obviously working in this space on a regular basis. And Tracy is our go-to for the car dealership owner scenario. The other thing I always like to mention before we drop off of a call is at John Hancock, we do have what we call concierge underwriting for your high net worth clients. So the definition of high net worth is going to be somebody with a net worth of at least $10 million applying for at least a $5 million death benefit. So anyone up through age 70 applying for between 5 up to 65 million a death benefit. If they are the type of client, which most of these high net worth ones are, who go to their doctors on a regular basis for physicals, we can actually send them through underwriting without an insurance exam. So we would just underwrite with APS records only. So just want to make sure everybody is aware of that, because sometimes that insurance exam is not the most pleasant of the experiences through the underwriting process. But so whenever we can get them through without an insurance exam, we'll do our best. And in that market, we tend to have about 80% success. About 8 out of every 10 cases are able to be underwritten with medical records only. That's all I have. So any other questions for Tracy or myself before we finish the call?
No, I mean, we'll give a couple more minutes here for questions to come through. I mean, is there anything you guys really want to leave on? I mean, I think this is a great presentation. I think take a lot away from it, but any last remarks you guys want to give?
Yeah, so one of the things that I always like to end with is these kind of cases can get very specific very quickly. What we like to do is just give a brief overview of kind of, why this worked in a particular case, what were the factors that went into that, and how it might translate to other similar clients. In this case, for any client that has, has illiquid business assets, they're looking to transfer out of, that, but they need to find some liquidity, or the sale to a grantor trust is a great way for clients that that the goal here really is that estate freeze, as well as finding a little bit more liquidity someplace. So these cases, we try to distill them down in the to make them easy to digest. But in every client situation, that can get pretty complicated. So we don't expect anybody else to be the experts on this. Feel free to give us a call, work with your ORG counterparts, and we can certainly help in any of these cases. Move the case along as much as possible.
Well, awesome. Kimberly, Tracy, I appreciate you guys hopping on here. Been a great webinar, and yeah, we love our partners over at John Hancock. I appreciate the partnership we have. And if any of you feel like you have a case or a situation that can correlate to this, reach out to your life rep here at ORG. We'll get you in contact with the John Hancock team. We'll make it happen. But appreciate you all hopping on. I know all our advisors on the call are very busy. We appreciate your time as always. Stay tuned for May's webinars. We'll be focusing on Disability Income Awareness Month. It'll be a lot of fun. But once again, Tracy, Kimberly, we appreciate the time and appreciate everybody hopping on.
Thank you very much.
Thank you, guys.
Thank you. Bye, Jacob.
Bye.